So somewhere along the way, someone decided that being good with money has to be hard. You need a spreadsheet, you need a budget app, you need to track every single purchase, feel guilty about your lunch, wake up at 5 in the morning to read market reports, and turn personal finance into basically a second unpaid job. That is a completely unnecessary way to live, and I am going to show you why. Here is something they teach in engineering and applied mathematics. There's an entire branch of math called optimization theory. Its whole purpose is to find the best possible outcome, the maximum result, while using the minimum amount of resources to get there. Engineers use it to design fuel-efficient engines. Computer scientists use it to write faster algorithms. The whole point is to get what you want by doing as little unnecessary work as possible. In optimization, laziness is not a character flaw. It is the definition of efficiency. A system that achieves its goal with less energy is not lazy, it is better designed than one that requires constant intervention to function. Personal finance is not complicated. People have just been treating it like a manual system when it could be an automated one. They've been burning energy turning dials that do not need to be touched. Here is the thesis for today. We are going to treat your finances exactly like an engineer treats a system. We have an objective function, maximize long-term wealth. We have a constraint, daily effort equals 0. And we are going to solve for that. One afternoon of setup work, then we're done, completely, for decades. If that sounds too good to be true, stick around, because I'm going to walk you through exactly how the math works, and you could check it yourself.
Let me tell you why traditional budgets fail. And they do fail. Study after study on personal financial behavior confirms that most people who set up detailed monthly budgets abandon them within a few weeks. This is not because those people are bad with money. It is because the budget was designed incorrectly. Traditional budgets operate on willpower. They require you to make a conscious decision every single day to not spend money that is sitting right there in your account. You get paid, the money lands in your checking account, you can see it, you can feel it, and the budget says, at the end of the month, move some of that money to savings. Here's the problem. Willpower is not a stable resource. It is more like a battery. It drains throughout the day as you make decisions, work decisions, social decisions, small daily choices. By the time you are sitting on the couch at the end of the month, thinking about transferring money to savings, the battery is low. The path of least resistance is to just not do it. The money gets spent. This is not a moral failure. This is how human cognitive resources actually work. So we're going to do something different. We're going to build what I call a zero-willpower architecture. The entire goal of this architecture is to remove the human decision-making element from saving money. Not reduce it, remove it entirely. In systems engineering, there is a concept called friction. Friction is anything that makes a process harder to complete. The higher the friction, the less likely the process is to happen. The lower the friction, the more automatic and inevitable it becomes. Right now, manually saving money at the end of the month is a high-friction activity. You have to remember to do it. You have to have enough discipline left in the tank to actually follow through. You have to overcome the inertia of seeing a balance in your checking account and choosing not to spend it. The solution is to make saving a zero-friction activity. Specifically, you automate it so that it happens before you ever see the money. This is the mechanical core of the whole system. When your paycheck arrives, it gets split immediately before it hits your main checking account, with one portion going automatically to your investment account. You do not see it, you do not decide on it, you do not have to exercise any willpower at all. Most employers today allow direct deposit split between multiple accounts. You go into your HR portal or payroll system, add your investment account as a secondary deposit destination, and set a fixed dollar amount or percentage to go there automatically. If your employer does not support split direct deposit, you set up a standing automated bank transfer on payday. The money moves before you have any chance to spend it. This setup takes somewhere between 30 minutes and 1 hour, depending on how user-friendly your HR system is. You do it once, you never touch it again. The architecture runs on its own, completely independently of your mood, your willpower, your stress level, or whether you remembered to do anything. The system doesn't care. It just runs. That is what we want, a machine that does not require your emotional participation to function.
All right, so the money is now automatically moving somewhere. The next question is where exactly it is going and what it is doing when it gets there. There is a whole industry built around convincing you that investing is complicated, that you need to read earnings reports, watch the news every morning, make judgments about which company is going to perform better next quarter, actively manage a portfolio, react to market events. All of that takes effort, and the evidence does not actually support it producing better results than the alternative. Decades of research on actively managed funds, funds run by professional analysts who spend their entire careers doing exactly this, show that the large majority of them underperform the simple, boring, do-nothing alternative over long time horizons. The people working hardest at this are usually not winning. That is a very useful data point. The boring alternative I am referring to is the broad market index fund. Specifically, for most people in most situations, an S&P 500 index fund. Here is what that actually is in plain terms. The S&P 500 is an index of the 500 largest publicly traded companies in the United States. We are talking about Apple, Microsoft, Amazon, Google, JP Morgan, Walmart, the most significant companies in the American economy. When you buy a share of an S&P 500 index fund, you are buying a tiny piece of all 500 of them simultaneously. Your money is automatically distributed across every single one of them based on their size. Here's my favorite way to think about what you are actually doing when you make this investment. You are hiring 500 of the most aggressive, highest compensated CEOs on the planet, along with their millions of combined employees, to work 80-hour weeks on your behalf. They are innovating, they are competing, they are sweating quarterly earnings, they are negotiating deals and expanding into new markets. They are stressed. You, on the other hand, are sleeping. And because you own a piece of their combined output, every time they generate value, every time Apple sells a phone, or Amazon ships a package, or Google runs an ad, you collect a share of that. Not because you did anything, because the ownership stake is doing the work. This is called passive investing. The word passive here is not a criticism, it is a description of the mechanical relationship. You own the asset produces returns. You did not have to participate in the production of those returns at all. This is the correct relationship to have with your investments if your goal is to minimize daily effort. In practical terms, this means you want to open a brokerage account, Fidelity, Vanguard, Schwab, set up your automated transfer to go directly into that account, and then set up automatic purchases of a broad market index fund. The specific ticker you are looking for is something like VOO, VTI, FXAIX, or SCHB, depending on the brokerage. Low expense ratio, broad market exposure, set the purchases to happen automatically when money arrives. You do this once during the same setup session as your automated transfer. After that afternoon, the full mechanical system is running. Money leaves your paycheck, it lands in your brokerage account, it automatically purchases index fund shares. Those shares grow in value over time as the 500 companies you own a piece of do their jobs. You check in once a year if you feel like it. You do not have to do anything else.
Now, let me show you the actual numbers, because this is where the system stops sounding theoretical and starts sounding absurd in the best possible way. Let's take a practical, everyday example. Someone is 25 years old. They set up the automated system we just described. They automate $10 a day, which works out to roughly $300 a month, into an S&P 500 index fund. Then they leave it completely alone for 30 years. The historical average annual return of the S&P 500, going back roughly a century, including crashes, recessions, and every bad period you can think of, is approximately 10%. This is not a guarantee about the future, but it is the long-run average we have. So let's use 10% as our working number. $300 a month invested at 10% annually, compounded monthly over 30 years. Let's run through what happens. After 10 years, you have roughly $227,000. You put in $36,000. The rest is compounding returns. After 20 years, you are looking at around $680,000. You put in $72,000. After 30 years, the number is somewhere between $1.8 million and $2 million. You personally contributed $108,000 over the entire 30 years. The rest, the vast majority of that balance, is the market doing work on your behalf. $1.8 to $2 million from $10 a day, set up in an afternoon at age 25. Now here is the part that matters from an optimization standpoint. Think about the ratio of input to output here. The input was roughly 60 minutes of paperwork, setting up the accounts, routing the transfers, picking the fund. That is it. That is the full labor requirement for the entire system over its entire lifetime. The output, 30 years later, is a portfolio worth close to $2 million. In terms of return on energy expenditure, this is the most efficient trade in personal finance. You cannot out-hustle this ratio. You cannot work your way to a better return per hour of effort than 60 minutes of setup producing a 7-figure portfolio. The math simply does not support a more efficient approach. The reason it works is compounding. Compounding is the process by which your returns generate their own returns. In the early years, the growth looks modest. In the later years, it becomes genuinely disproportionate because you are now earning returns on decades' worth of accumulated gains, not just your original contributions. Time is the critical variable in the equation, which is why the most important single thing you can do is start early rather than wait until you have figured out the perfect strategy. A mediocre strategy started today beats a perfect strategy started 10 years from now in almost every scenario.
Now, I know what some of you are thinking right now, because I have heard these objections before, and they are reasonable questions. So let me address them directly, one at a time. Objection number 1. What if the market crashes right after I invest? This is the most common concern people have, and it is based on a misunderstanding of how the system actually operates over time. Yes, the market crashes. It has crashed many times in the past 100 years. The dot-com crash in 2000, the financial crisis in 2008, the sharp drop in early 2020. Every single one of those crashes eventually recovered, and the market went on to reach new highs. That is the historical pattern, not a guarantee, but a consistent pattern across more than a century of data. Here is the more important point. When the market drops and you are still running your automated monthly investment, you are buying shares at a lower price. You are getting more units of the index fund for the same $300. This is called dollar cost averaging, and it is one of the quiet benefits of the automated system. You are not trying to time the bottom. You are just consistently buying, and a lower price means you are buying more. When the market eventually recovers, and historically it has, those extra shares you picked up during the downturn are now worth significantly more. The worst thing you can do during a market crash is panic and stop the automated transfers. The second worst thing is to manually sell your holdings. The correct thing to do is nothing, which conveniently is what this system is designed for. Objection number 2. I don't have $300 a month. I'm just getting by. This is a real constraint, and I'm not going to pretend otherwise. But here's the thing about the math. The specific dollar amount matters less than starting. If your number is $50 a month, start with $50. The compounding mechanism works at every scale. $50 a month at 10% over 30 years is still over $100,000. That is not nothing. That is a meaningful financial cushion built entirely on $50 and one afternoon of setup. Start with whatever you can genuinely automate without feeling the pinch. $25, $50, whatever number you wouldn't miss because it leaves before you see it. Then, every time your income goes up, a raise, a new job, a side project, bump the automated amount by half of the increase. You keep half, the system gets half. You never adjust to spending the full raise, and the investment amount grows over time without requiring any active decision-making. Objection number 3. What about taxes? What about fees? These are legitimate things to be aware of, and they are also things the system handles structurally with minimal effort.
For taxes, the simplest move is to run this system inside a tax-advantaged account, a Roth IRA or a traditional IRA, depending on your situation. In a Roth IRA, you contribute money that has already been taxed, it grows completely tax-free, and you pay zero taxes when you withdraw it in retirement. The annual contribution limit, as of right now, is $7,000, roughly $580 a month. For most people, that covers the full automated investment and then some. You get the full compounding benefit without the tax drag. For fees, this is where your choice of index fund actually matters. Look for funds with an expense ratio below 0.1%. Most of the major S&P 500 index funds from Fidelity, Vanguard, and Schwab are right around 0.03 to 0.05% annually. That is essentially nothing. You are paying a few dollars a year for the fund to run. Compare that to actively managed funds that charge 1 to 2% annually, fees that compound against you the same way returns compound for you. Low-fee, passive index funds are not just the lazy option, they are frequently the mathematically superior option once fees are factored in over decades. So the objections are reasonable, and the answers are also reasonable. The system handles them structurally. You do not need to actively manage around any of this. You pick the right account type once, you pick a low-fee fund once, and then the objections dissolve into the background on their own.
There is a psychological side to this system that I want to talk about because I think it is actually one of the most practically valuable parts of the whole thing. When people manage their finances manually, tracking every purchase, budgeting by hand, trying to optimize every spending decision in real time, they carry a background level of financial anxiety with them all the time. Every coffee purchase becomes a moral event. Every dinner out requires a mental calculation. Every time they sit on the couch and watch television instead of working on a side hustle, there is a nagging sense that they should be doing something more productive with their money or their time. This is an exhausting way to live, and it does not actually produce better financial outcomes than the automated system. It just makes you more anxious. Here's what the automated system changes. Once the architecture is running, the investing variable in your financial equation is already solved. The money is moving, the index fund is being purchased, the compounding is happening. The system is taking care of itself without any input from you, which means that whatever money remains in your checking account after the automated transfer, all of it, is genuinely, mathematically yours to spend however you want. You do not need to feel guilty about coffee. You do not need to optimize every dinner decision. The financial engine is already running in the background, and your remaining spending money is not stealing from your future self. You have already taken care of your future self, automatically, before you even checked your balance this morning. This is the thing people get wrong about the lazy approach. They assume it means neglecting your finances and hoping for the best. It does not. It means building a system that is already doing exactly what you need it to do, so that your active daily life does not have to be about money management. True financial laziness, the good kind, is not sitting on the couch worrying about whether you are saving enough. That is not relaxation. That is low-grade stress parked in front of a television. True financial laziness is sitting on the couch knowing with certainty that the machine is already running. The transfers have already happened. The index fund shares were already purchased. 30 years of compounding is already in progress. You do not need to do anything. You have already done it. The architecture makes peace of mind automatic. That's the real product here, not just the portfolio. The ability to stop thinking about money on a daily basis because you have already solved the problem structurally, rather than solving it every single day through manual effort. And once you're not spending mental energy on daily financial management, that energy is available for whatever you actually want to do with your time, which is presumably not managing money.
All right, let me bring this back to where we started. Personal finance does not need to be a hobby. It does not need to be a second job. It does not require daily attention, constant optimization, or a subscription to 17 financial newsletters. What it requires is a one-time setup of a simple, automated system. Here's the entire thing in plain terms. Step 1. Figure out a fixed amount to invest each month. Even something modest like $200 or $300 is a real starting point. Step 2, open a brokerage account at Fidelity, Vanguard, or Schwab. Step 3, set up an automated transfer from your paycheck or bank to that account on payday. Step 4, set up automatic purchases of a broad market S&P 500 index fund inside that account. Step 5, close the laptop. That is the whole system. One afternoon, maybe 2 hours if you run into paperwork. After that, you are done. The machine runs, you do other things, decades pass, the portfolio grows. You do not need to watch the market, you do not need to rebalance constantly, you do not need to react when the news is bad. In fact, the best thing you can do for this system during a market downturn is nothing. Keep the automated transfers running, keep buying shares at lower prices, then stop thinking about it. The long-run average takes care of the rest. Finance is an optimization problem. You have solved it. The objective is being met. The constraint of zero daily effort is satisfied. There is nothing left to do except let time pass and let compounding do its job. I'm Dollar Dave. Set up your system and go do whatever you want.